Welcome to this week's episode of Accredited Investor Markets Radio. Each week we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I'm Christopher Cahill, your host. In a short while, I'll be speaking with Marshall Saunders. Marshall Saunders is managing partner of SaundersDailey. Okay, yes, it's another online platform, but here's the difference. SaundersDailey is a hyper-local investment platform in Minneapolis-St, Minnesota. And the locality is key here, not just because up there in the frozen north, all the children are above average, but SaundersDailey is a real estate investment platform which looks only at areas that they know extremely well in the Minneapolis-St. Paul area. So they know the streets, they know the neighborhoods. They can identify value and look at it more reliably. At least that's their pitch. So it's collective real estate investing for real estate locavores who want access to bigger deals. I invite you to stick around and listen to that. But first, a few words about peer-to-peer lending. It's really remarkable how in this age, this mature internet age, both tech and finance move forward so quickly. In just months, we have a narrative about an entire industry unfolding before our eyes. September 15th, 2015, Dave Friedman wrote in Accredited Investor Markets the article, "Watch Out for Subprime Peer-to-Peer." In it, he noted the fantastic growth of peer-to-peer lending. Of course, peer-to-peer lending really means lending not by banks. It's really not peer-to-peer. The larger peer-to-peer lenders are backed by private equity and so forth, but it's okay. They're filling a gap that banks aren't able to fill. That's been the constant from the beginning. Anyway, Friedman notes that the largest peer-to-peer companies are securitizing bundles of their loans, selling them to Goldman, BlackRock, and Morgan Stanley, and the like. That provides them with an incentive to get more loans. How to get more loans? It's not that easy. And Friedman suggests the possibility that one way to get more loans that will arise and manifest itself is to relax the criteria for loans to take on riskier borrowers, which is a dynamic taken together with securitization, which played at least some role in the financial crisis. He's not predicting another financial crisis. It's a $7.8 billion market, not a $1 trillion market, but nonetheless, it's a dynamic Friedman identifies. Well, let's fast forward from July to October. The October 2nd, 2015 Wall Street Journal article, "Online Lenders Deluge Small Businesses" by Peter Rudiger and James Steingold, repeats or looks anew at some of the conclusions Friedman made. A few quotes. "Online lenders are tripping over each other to find new customers. More established online lenders complain that some of their rivals are ruining the market." That one's particularly delicious. "These guys are new. They're peer-to-peer lenders. They're the disruptors. Well, now they're the incumbents as others take the stage of a very lucrative business with here from the outside to be low barriers to entry." One more quote from the article. "Others worry that the outcome will inevitably be imprudent loans," which is precisely what Mr. Friedman was writing about. I guess it's a long 2.5 months ago, because things keep evolving in this industry. Well, in the article, it is described how the dynamics of this market have led to intense marketing by these new arrivals. So the incumbent peer-to-peer lender finds a small business borrower, or vice versa, who's not being served by banks, and gives them a marketplace loan. Now, a marketplace loan is pretty high interest rate, but it's money and it's quick. And if you needed to make payroll over the next few months until a big receivable comes in, well, as a small business person, you'd be obligated to do that to keep your business going. The problem presented by these rivals to the incumbent peer-to-peer lenders is that through this marketing, they're encouraging, pressuring, begging, maybe, small business owners to take out other loans called follow-on loans or stacking of loans for those who have a more abstract appreciation for what's going on. And the heck of that is, if the peer-to-peer lender lent to a good borrowing risk, all of this on an unsecured basis, follow-on loans, because of the high interest rates of those, imperil the earlier credit. They degrade the quality of the credit that presented itself to the incumbent peer-to-peer lender in the first place. Well, we shall see what happens next. Should be interesting. There's something else on Accredited Investor Markets that I wish to point your attention to. We recently published A Few Minutes with Neha Manaktela, CEO and co-founder of Deal Index. I had the pleasure of speaking with Neha a few days ago, and she's brilliant and runs a really impressive business, not her first in this area. What's Deal Index? Well, it's based in the UK. She is based in London. It aggregates data about private companies and about private companies seeking financing, seeking capital. And it aggregates this all in one place. It curates the data carefully. It engages in extensive research and analysis and presents it all in what it calls a dashboard, which gives you a picture of private companies raising capital across leading alternative investment platforms globally. And we've talked about dozens and dozens of online investment platforms on this show, and you can see lots of articles in our very deep archive of articles about online investment platforms. They are the basis on which peer-to-peer lending, to go back to the beginning of our discussion, they are the platform on which peer-to-peer lending takes place. And so these things are proliferating across the world. How to make sense of them, how to seize opportunities, especially internationally. But markets, you don't understand that well. But through the intervention of something like Deal Index. And if you look at Deal Index, and if you sign on to the dashboard, you'll see they too have a good amount of just research articles so you can learn the different modes of investing in private companies worldwide and helping them raise capital. It's not as deep as our bench here at Accredited Investor Markets, but it's awfully good. You do well to read both. This is in a time when public markets in the U.S. and internationally are under great stress. Now, perhaps more than at other times, it makes sense to consider putting a safe percentage of your portfolio into overseas private company investments. That was not a recommendation. I am not an advisor. But if you want to learn more about these sorts of things, we suggest that you read our work in Accredited Investor Markets, and you might take a peek at Deal Index as well. Well, let's get to the interview. Well, hello, everyone, and welcome to Accredited Investor Markets Radio. I am Christopher Cahill. I have with me today Marshall Saunders. Marshall Saunders is managing partner of SaundersDailey. Now, you find out about SaundersDailey by going to www.saundersdaily.com. SaundersDailey smushed into one word, as is the norm. Well, SaundersDailey is a hyper-local investment platform in real estate in Minneapolis-St. Paul, Minnesota. In September 2014, Marshall sold his half-ownership of RE/MAX Results to his business partner in order to pursue his interest in community-funded real estate. Marshall was a broker-owner in RE/MAX Results since October 2008 and helped grow that business until it doubled its number of agents and offices and became the largest RE/MAX franchise in the world. Having tasted such success with RE/MAX, Marshall wished to create SaundersDailey. Thank you for being with us today, Marshall.
Thank you very much, Christopher.
All right, so SaundersDailey has now lived from September 2014 to September 2015. Marshall, has it been a very good year?
Yes, it has. It's been a very good year. It's been full of a lot of adventures and a lot of legal bills, setting up what we set up. But yes, it has been a very exciting, a very challenging, and a very good year.
Well, about those legal bills, since you mentioned it, were any of those unexpected? I mean, anytime you set up a business, you're going to run into those kinds of expenses.
Yeah, they were not necessarily unexpected. You know, this industry is so new, the whole industry of crowdfunding. And so therefore, you never know what to expect. And I would say that I expected to have a lot of legal bills, and they were about twice as much as I expected. However, it was necessary, and because it's really important to do this correctly. We want to be the model that the SEC points to and the industry as a whole points to and says, that's how you do it. That's how you do it right. And so we've been spending a lot of money on legal bills that sometimes just to double check and triple check a position, just to make sure that we're doing everything right and that we can be the model for the industry.
Well, all right. Now, you're a hyper-local investment platform in real estate. Real estate platforms are actually burgeoning on the web. There are lots of online real estate platforms. And I read something interesting to me this morning that I'd like to share with everybody and then ask you about. It was an article by Stephen Dresner of DealFlow. The title is, Stop Wondering Why Real Estate Crowdfunding and Online Lending Are Booming. Hint, it's the data. Well, in the article, Mr. Dresner posits that the reason real estate online transactions have taken off is the nature of the data in real estate transactions. It's reliable data. The kind of data you always see in real estate transactions translates well into less personal transactions over the web, similarly to online lending. Again, it's a lot of factors that you can understand. They're tractable, even though you can't actually see and put your hands on anything. By contrast, to say online purchasing of actual operating companies or startups, which are much more complicated. So it's the nature of the data and the stuff being invested in, which explains why these things are so popular as far as investment platforms. But you, Mr. Saunders, you have an additional dimension of value that you can add by being hyper-local. Isn't that right?
That's right, and I don't have a big problem with what the article put forward. It is true. We are so used to seeing real estate online. We're used to going Zillow and Trulia, and when we look at homes to buy, we're very, very used to the idea of going online and seeing the bedrooms and the bathrooms and all the tax information. And also, there's been a real strong history of real estate syndication for investment property and for investment real estate. And real estate syndication is so closely akin to real estate crowdfunding. It uses much of the same terminology. It walks and talks much like real estate syndication. So that might be why real estate is so much more prevalent in the crowdfunding world. You're right. We take a different tact, a slightly different tact than other real estate crowdfunding sites do, and we are hyper-local. In the fact that a lot of broad generalizations can be made about a zip code, say 55405, the zip code I'm in. But unless you're on the street and you know real estate really well, you know that the 55405 might have a general vacancy rate of 3%. But you know that is made up of an average. And on Hennepin Avenue, the vacancy rate is 6%. And off of Hennepin Avenue, the vacancy rate is 0%. And unless you had a hyper-local kind of knowledge about the real estate industry and a street-to-street knowledge, you would take it as a generality that it's 3% and then be kind of surprised if you bought something on Hennepin Avenue that had a 6% vacancy rate. Those are the kind of things that long experience in the real estate market, a long experience in the local real estate market can kind of hone in on. And that's where being local like we are, I think, leverages an important difference.
Now, that reminded me of an encounter I had about 2 years ago. I was a passenger in a car being driven by somebody not from the area. And we were driving to an address in my hometown, the town I grew up in, a town in which I knew certainly every street, but I knew virtually every house at one time. Anyway, she was driving and she had a GPS monitor in the car, and she looked at the GPS monitor to guide her. I said, "Hey, you should take a right here." And she completely ignored me. And in my hometown, right? Because she had greater faith in this, highly advanced technology, which is very reliable, but limited in the sorts of knowledge it can give. Whereas I had knowledge about that town that would be much more, say, relevant to a real estate transaction than the GPS
Absolutely.
would.
It's a great example, but not only does this have kind of a homey touch or kind of some relative value like that, but it's, I think, a far more big economic value. I think a lot of, when we look back in real estate, the downturn that occurred, the devastating downturn to our economy that really started in late 2006, but hit its peak in 2008, 2009, 2010. A lot of that we see is the distance between people who owned risk and the actual risk. The risk in mortgages was packaged, packaged, and repackaged. And people who owned the risk, who owned these mortgage-backed securities, had no idea where these properties were, had no idea of their locality, had no idea of the forces going on in the neighborhood, and thus had no way of even coming close to touching knowing the knowledge that you would need before you own that type of risk. And it was that blindness that really led to certainly a factor in the huge problems that we had in real estate. Not only are we taking this local just because we're local guys and we know our local area. That's great. That's cool. But what we're trying to do is have properties owned by the people who live in the neighborhood, have the investors know what we're investing in, and so that the distance between the risk and the people who own the risk is not that great, and they can drive by on a daily basis if they want. Maybe they just drive by once a year. Maybe they never drive by, but at least they have an idea of where it is and the look and feel and touch of it. And I think it's really, really important to bring investor money local when it's talking about real estate. I think it's really, really key on a huge economic stability level. It's very important. And so that's why I'm kind of passionate about that. I really feel that that's important.
Well, Many is the real investment advisor who counsels that an underappreciated aspect of investing is to limit your downside risk. And I guess when you are approaching the kinds of the dynamic that you're cultivating, you are certainly limiting downside risk compared to buying tulip bulbs.
Right.
Which is a reference to a tulip bulb bubble that occurred in the 19th century. Anyway, go on.
I know it well. Yeah, I know it well. And you're absolutely right. And also, on our platform, we leverage everything that we buy 50%. So we put 50% as financing and then 50% equity. And in that respect, we're, I think, bringing an element of stability to the economy as well. Not everything is over-leveraged. Not everything is going to go into foreclosure when we see a 10, maybe even, as horrendous as a 15% dip in the market. Not everything is going to be going into foreclosure right and left and creating a deflationary spiral in income-producing property. And I think that's another element that we bring of localness and a lot of equity and just creating a great market to invest in, but just bringing a little bit of saneness and a little bit of stability to that market.
All right. Well, consider somebody who has never invested through a real estate crowdfunding platform of any kind. What investment opportunities does he or she find on SaundersDailey?
Primarily smaller stuff. For instance, we have a single family home on there. We have a fourplex apartment building. We have a small 8-unit, 8-lot development that's coming online, 3-story office building, a smaller apartment complex consisting of 36 units, another one consisting of 33 units, that type of thing. Not huge things, not $5 million here, $5 million there. Generally at the height, we get to about $1.8 million. And again, half of that is financed, half of that comes from our investors, investor owners. So that's the type of stuff that they would find. Our first investments, our first offerings, have a minimum as low as $2,200, $2,500. One has a minimum of $3,000. So it really, what we're going for is that middle-of-the-road investor. We're not looking for them to cash out of their 401k plans or cash out of this or sell this stock to be able to pay for it. We're looking for accredited investors, people who make above $200,000, but that have $2,500 or maybe even $5,000 in their checking account to write a check from. That's the kind of investors we're looking for, because prior to this, those investors have not been sought. It takes more than that to buy a single-family home and rent it out. Certainly takes more than that to do a multifamily or multi-residential dwelling. To participate in that takes way more than that. And those investors are never reached out and sought by people who are putting together large real estate investments. Those folks are looking for people who bring $100,000 and $300,000 to the table. They don't want a bunch of people who bring $3,000 to the table.
Well, it occurs to me that, a junior, a professional, middle level professional or doctor or business owner will have opportunities to participate in somewhat larger deals than they would otherwise, but not gargantuan deals. It also strikes me that with that low of a minimum, when we have genuine crowdfunding in this country, and at some point I suppose we will, you'll actually be well poised to have non-accredited investors. Once again, that becomes the regulations allow it, participate in these deals. Isn't that right?
Absolutely. I never need that to happen. If it happens, it's great. But we can run our company completely successfully only going after accredited investors. It's just fine. But there is an element of our company and our setup that we consider a bit of a dress rehearsal. We're going to run this company. This is how we're going to deal with investors. This is how we're going to have a customer service element to our business. And when true crowdfunding comes into place, we are going to be immediately ready to fully take advantage of that. In Minnesota, a law called Minvest has been passed and signed by the governor, and it has been given to the Department of Commerce to administer. And they are going to be coming out with their findings and their requirements for true crowdfunding probably within a matter of months. And so then that will be legal. Non-accredited investors will be invited to join investments like this once that becomes enacted.
Well, that's very exciting, because if there's one thing young people were able to pull together, $5,000 or $10,000 in savings, even if they're non-accredited investors, if there's one thing they should be able to do, and that's build wealth. And that's often very difficult to do, but a few of these, they might be all right.
I totally agree. I mean, of course there is a downside. There are going to be people ripping people off in the name of crowdfunding. It is going to lower the bar of what can be an investment, and that has its negative consequences as well. But ultimately, there's something totally unfair by the fact that someone who makes above $200,000 has access to these investments and can invest in a startup and can invest in this building and can be pooled together into a group of investors. But someone who makes under $200,000 is not trusted to use their own money the way they see fit. They can go out and gamble in Las Vegas and they can buy lottery tickets all day long. That's legal. But they can't invest in a startup. They, like you said, they do not have the avenues of wealth building that wealthier people do. It's an unlevel playing field, and it's unfair. And it's going to be fraught with disaster, and there's going to be a lot of administration that needs to be done to protect folks from getting ripped off. But the fact is, that's work that should be done because that is the right thing to do. It is totally unfair that people who make less have less access to wealth than people who make more. That's not the American way. The American way is, hey, we all got the equal chance. Some people use it, some people don't, some people lose, some people win, but it shouldn't be rigged against you from the get-go.
The way gambling is.
Yeah, right.
And well, truly. Anyway, you have said that crowdfunding enhances transparency of real estate investing, and you've also discussed, I guess, a little bit already about how the local focus reduces due diligence risks. This actually combines with what you were just saying about protecting investors of all kinds. Well, would you comment a little bit on those things?
It's going to be a challenge, and I think it's up to our industry, the crowdfunding industry, to set a standard, and of course the government will have to jump in and say, hey, this is a requirement of reporting, this is the requirement of doing this, and I welcome that. It is a double-edged sword. There's one positive, we're going to be close, we're going to be, I don't know who to call for my mutual fund. I don't know the guy to call. Right now, I'm sitting in my office, and there's two of us in here, and my cell phone rings directly. So the nice thing about the transparency of working with a crowdfunding company is it doesn't have multiple layers of bureaucracy between you and the person making the decision on the investment, and that immediately implies a certain level of transparency. However, there's going to be so many people in the market now who do not, because it was prohibited, do not have the experience in investing in these types of investments, and they're going to have some unpleasant surprises and hopefully some pleasant surprises, and it's going to be an issue, and it's going to be up to individual companies as to how they report and how they maintain their transparency. And that's why we are trying to be just a shining example of how to report on a quarterly basis to every single investor owner what's going on, what our plans are for the future, what your returns were, what made them lower or higher in an individual month, all of that stuff. But it's going to be a challenge.
All right, so how do you make your money on these transactions through the platform?
Two different ways. First of all, our platform is for hire. So SaundersDailey, if a person has a real estate investment locally here, they can bring it on our platform. If we're not financial advisors. However, we do some minimal vetting of the person and the investment before they come on our site. And they pay us to do that. But then there's a lot of stuff on our site that we are sponsors of, SaundersDailey ourselves. And in that respect, how we make money is we have a 10% retained ownership of the real estate that we buy. So all the investors together that accumulate all of the money to buy the property, altogether they own 90% of the property and we own 10%. And so in that way, we don't take money off of your earnings. We sit right beside you. So if someone owned 10% and we have our retained 10%, we made $100 off of rental income that quarter. They make $100 off of rental income that quarter. We don't take a commission or a fee off of their money. If they earn $100, they get a check for $100. But we're right next to them, getting our 10% of that number. There's also a one-time acquisition and disposition fee that our investor management company charges. So if we buy a property for $100,000, there's a $2,000 fee that is collected out of rental income over the first year. And other than that, we do not charge anything. That's our full way of making money at this company.
Well, all right. So if it's hyper-local, that means that this isn't scalable beyond a certain scale. You might be able to do all of Minnesota, maybe, but not much beyond that, I would think, without losing your hyper-local character.
Yes, we will be hyper-local. However, we can hire people or take on partners in different cities.
Yeah.
For instance, we have partners in Indianapolis that we would be part owners of SaundersDailey in Indianapolis. And they would provide the hyper-local access as long as they have been in the industry and in real estate for a long period of time, have a lot of, depth in that market, and we would basically be partnering with them. They would be the local experience. We would bring the technology.
All right, so then is it possible then that a property would be listed with you and also with another, say, national real estate crowdfunding site, or do you get exclusivity?
It would be exclusive to us. If it's on our site, ours is the only place that it's being offered.
So conceivably, you, because of your hyper-local value add to the transaction, it's conceivable that the price could actually be a little higher because of the reassurance that comes from the due diligence you're able to do.
So far, I haven't seen that to be true. So far, we've been kind of on the ground using all of our resources. We know so many of these sellers. We know so many of these deals. We can usually get on long before they are on the market or widely known to people, and therefore we have usually come up with a little bit better deal than you would get otherwise. I don't know if it's all that much better deal than some other national real estate crowdfunding site would get. I can't claim that, but I don't think it's any worse.
Yeah. Well, it's a real interesting proposition, and I was glad to learn about it in preparing for this interview. Marshall, it's been a pleasure having you on.
Thank you very much, Christopher. It's been a pleasure talking with you.
All right. You've been listening to Accredited Investor Markets Radio. Thank you for doing so. Accredited Investor Markets Radio is produced by Stephanie Strait. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.